Every private company in Canada has a not so secret advantage tucked away into the tax toolkit, and this is called the Capital Dividend Account, or CDA. So it's often misunderstood and even overlooked, but the CDA is a really powerful mechanism that allows for businesses to flow money to shareholders in a tax-free way. Now, why does it exist and how does it work? We're going to break down the essentials of this tax provision called the CDA. But first, hi. My name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial. And we've been helping Canadians with their finances and teaching them about how to use things like the Capital Dividend Account for more than 15 years. We've got clients all across the country, and we're happy to talk to you. So now, let's get into the video. The CDA is it's important to understand this for tax efficiency in your private company in Canada. So it's meant to integrate corporate and personal taxation. And, what does that mean? The CDA lets shareholders to get certain tax-free dividends. But really, what exactly is it and how do you as a business owner leverage it effectively? And then this video today, we're going to go into the mechanics, we're going to go into the applications and the strategic opportunities of the CDA. So why a capital dividend account exists? The CDA was introduced, it was part of the Canadian Income Tax Act. And the main goal is to minimize double taxation when your income goes from a corporation to shareholders. So without having a mechanism like the CDA and the dividend tax credits, then your shareholders could face excessive tax burden, and this erodes your returns because you don't want that. And a key purpose of the CDA is to allow the private corporation, your company, to distribute tax-free amounts to shareholders when the corporation receives similar tax-free amounts. So what are these? These include things like non-taxable portion of a capital gain, life insurance proceeds, and then there's other qualifying things. So the distribution of tax-free life insurance proceeds is what makes the capital dividend account very relevant for this channel, since we talk about life insurance so much on here. That's why we're talking about this today. And then how does it work? The CDA is what's called a notional account. So it's only relevant for tax purposes. And your CDA balance, it accumulates over time. So this allows your company to pay out tax-free dividends up to whatever is your available CDA balance. And then to take benefit from that, your company needs to file a specific type of election with the CRA, and you'll get your accountant to do this. Or if it's after you pass away, you leave instructions for your accountant to do this. So when you're using the CDA, the timing is important. Then you could have events like the sale of assets that generates a capital loss, or you're transitioning from a private firm to a public company. So this affects your CDA balance, which means that you need to stay on top of it, and you need to make sure you're working with professionals who can track it while you're doing your proactive tax planning. Now, what makes up a CDA? So there's basically 4 things that can create CDA for your corporation. So the first one is the non-taxable portion of your capital gain. So when you generate a capital gain in your corporation, 2/3 of that is subject to capital gains since the 2024 federal budget. So where it increased the capital gains inclusion rate. The other 33%, the other third, is the non-taxable portion of the capital gain that's realized by your company. So this is added to your CDA, your capital dividend account, which then can be distributed to the shareholders. It's the non-taxable portion of your capital gain. If you receive a capital dividend, so any capital dividends that are received by your company, those are added to your CDA. They make your balance go up. And then life insurance proceeds. So when a life insured dies, the death benefit minus any loans and minus the adjusted cost base, or the ACB, creates CDA. And then this can be a payout to your corporate beneficiaries tax-free to your shareholders. Right? So this is an important thing for estate planning. If you've got money inside a holding company that you want to pass to your family or to whoever, that the life insurance proceeds can pay out to the corporation and then can pay out from the corporation to the shareholders through the CDA in a tax-free way. You also have eligible capital property gains. So the non-taxable portion of the gains from selling an eligible capital property also increases your CDA balance. And then when you pay out capital dividends to your shareholders, This reduces your CDA balance. So you can grow it and you can shrink it. So now let's talk about what types of companies can pay out CDA to shareholders. So you have what's called qualifying corporations and dividends. The only private companies that are in Canada can create and can use the CDA mechanism. So if your company is publicly traded, you can't. Even if you have pre-existing CDA balances from before, you cannot distribute a capital dividend. So if your private company goes public, you talk to your accountant about paying out any CDA balance before it goes public, and this is a way to get some money out tax-free. So in the Income Tax Act, this is discussed in subsection 83.2, which governs the declaration of capital dividends, cash dividends, stock dividends, or dividends in kind. Your accountant should document and file these properly to avoid any CRA penalties. And then now this is the most important part. Because our channel talks so much about life insurance, we're going to talk about life insurance and the capital dividend account. So life insurance is more than just the safeguard for the unexpected events. It's also an important component of a strategic plan for a corporation's capital dividend account. So when a private company is named the beneficiary of a life insurance policy, the net proceeds from that policy's death benefit, which is your total death benefit minus your adjusted cost base, that gets credited to the CDA. So you can make a very big CDA with life insurance. These credited amounts can then be distributed to the shareholders as tax-free capital dividends, which makes life insurance a super powerful tool for tax-efficient planning. Right? You'll also notice it says the life insurance death benefit proceeds minus the ACB. So you need to set up the insurance far enough in advance that your ACB will go down to as close to zero or as close to zero as possible so that you can get the maximum amount of death benefit that flows out to your beneficiaries of the corporation tax-free. So this strategy is especially valuable in scenarios like if you're funding a buy-sell agreement. So the life insurance proceeds can be used to facilitate the transfer of shares from the deceased shareholder's estate to the surviving shareholders. Also for corporate debt repayment. So the proceeds can help to settle any outstanding loans, especially if they were collateralized by the life insurance policy. So this would include when you're doing strategies like an IFA, an immediate financing arrangement, or an IRP, which is an insured retirement plan, or if you're doing a strategy like cash flow banking or infinite banking concept or bank on yourself. All of those, you need to work with your CDA and understand how that works. Also super important when you're estate planning for the shareholders. So by making sure the corporation has access to tax-free funds, life insurance helps to ease that burden on the shareholder's estate, and it helps to preserve their wealth. So now let's get real nerdy and into the weeds. So we'll talk about the impact of the 2017 tax reforms on life insurance and how that affected the CDA. So there was changes in 2017, which changed how the ACB of a life insurance policy is calculated, and it essentially reduced the amounts that are credited to the capital dividend account for policies that are issued after 2017. So those updates included the use basically of updated mortality tables and a new method for determining your NCPI, which is your net cost of pure insurance. So these revised calculations, they better reflect the increased life expectancy and the actual actuarial reserves, which in turn will lower the credit to your CDA. So for example, policies issued after 2017 typically have a lower NCPI, which keeps your ACB positive for longer. What does that mean? As you have a life insurance policy, over the life of that policy, your ACB is going to go eventually to zero or to close to zero. Previous policies, it did that more quickly. Today, policies after 2017, it takes longer for that to do it. So again, like I said before, if you're trying to set up life insurance for your corporation and it's part of your estate plan and you want to use it to create your CDA and have as much money flow out tax-free as possible, you want to set up the insurance as far in advance as possible so it has enough time for that ACB to go as close to zero as possible. So do your insurance as early as you can, as far in the future, as far away from the day you think you're going to die as possible. Since the 2017, these changes, they ensure a more accurate reflection of the insurance policy values. It also reduces the portion of the life insurance proceeds that qualify for CDA credits. So the reduction makes the choice of policy type and the ownership structure more important than ever. And then again, this is where an expert like us comes in, right? If you're setting up one of these life insurance policies so that you can generate the maximum CDA, you need to work with somebody who knows what they're doing and who can make sure that these numbers are right for your situation. And you can maximize the CDA benefits with your life insurance. So to fully leverage the tax advantage of life insurance within like this CDA framework, your corporation needs to think of a couple of things. So number one is who owns the policy. So you want to make sure that the corporation owns the policy and is the beneficiary. This will maximize the CDA for the corporation. You also want to make sure you have the right policy type. So you want to make sure that you can evaluate the impact of your ACB for different types of policies, especially today after 2017. And then you need to think about your estate and your succession goals, right? So your life insurance proceeds, they need to line up with your long-term goals, like your shareholders agreement, or you might have like an estate equalization in your family. And so life insurance like remains one of the most versatile tools in CDA planning, but the effectiveness depends on the proper structuring and the understanding of your tax regulations. So this is where you work with experts like us and where we work with your accountant to make sure that we're doing all of this to your best benefit. And then by understanding how life insurance and the CDA works together, your corporation can create a tax efficient way to get the money out to your shareholders or to your beneficiaries, and then it can preserve your wealth more, and it ensures a larger legacy to your family or to whoever are your beneficiaries. So in business planning, here's some applications of the CDA. So when you have your shareholder buy-sell agreements, these are super important. So if the shareholder dies, then the life insurance proceed can fund the purchase of the other person's, of the deceased person's shares. And the CDA allows a portion of these funds to be distributed as tax-free dividend to the estate or to the surviving shareholders. So then in this case, you need to make sure you have your wishes properly documented and that the corporation pays out the tax-free proceeds to who you and to when you want. Because we've actually heard stories where the shareholders pay out the tax-free CDA to themselves and they pay out to the deceased beneficiaries, they pay out taxable dividends. So this is a dickish move on the part of the remaining shareholders. They're taking this large tax-free payout for themselves, and then they're sticking the remaining spouse with the big tax bill and a lesser estate payout. Number two, you want to think about your share redemption by the corporation. So when the corporation redeems shares of the deceased shareholder, those proceeds can be split into tax-free capital dividends from the CDA and taxable dividends. So there's this could be tax efficiency for the shareholder's estate. So again, here you need to have your wishes documented so the tax-free portion and the taxable portion pay out how and to who you want. And then for corporate debt repayments, we talked about this a little bit, but life insurance proceeds used to repay the loans can still contribute to the CDA, which ensures your tax-free dividends for the shareholders. So this is big for people that are using strategies like the IFA, which we have videos on, or the IRP or infinite banking, because you might have large loans against your life insurance outstanding when you pass. But this allows that the loans to get paid out while still creating a big CDA. And then you might have what's called a crisscross agreement. So these arrangements, this enables the surviving shareholders to acquire the shares from the deceased shareholder's estate using the dividends that are funded by the insurance, which maximizes the CDA again. Some considerations and some risks that you should know about. So there's anti-avoidance rules. So the CRA can challenge transactions involving CDA under GAR, which is your general anti-avoidance rules, or specific provisions like 83(2). So misusing your CDA can result in penalties and changing your tax-free dividends to taxable. So you make sure that you do this properly with your accountant. If you're a non-resident shareholder, so capital dividends that are paid to non-resident shareholders are subject to a 25% withholding tax unless that number is reduced by a tax treaty. So you could have separate share classes to help optimize these distributions to resident shareholders or to non-resident shareholders. And again, talk to your tax lawyer about this or maybe your accountant, but probably a lawyer. Then you have late filing penalties. So filing the CDA election after the dividend payment, this incurs penalties. So again, proper planning, make sure you're compliant, make sure you work with your accountant, make sure you work with a professional so that all of these things are done and they're done at the right time and they don't cause penalties. So with the life insurance proceeds in the CDA, life insurance can create a big CDA, a big capital dividend account. And this is especially important when it comes to tax-free dividends for the shareholders. Right now, I've talked a lot, but let's look at some concrete examples. Now, let's say you hold life insurance in your corporation and your corporation is the beneficiary of the life insurance policy. And for easy numbers, the death benefit is $1 million. So when you pass away, the policy's ACB, the tax basis for the policy, let's say it's $150,000 still. So your CDA credit is, you take away this ACB from the total death benefit. So $1 million minus $150,000, your CDA credit is $850,000. Nice and simple. So this $850,000 can then be distributed to your corporation's shareholders as a tax-free capital dividend. And the remaining $150,000 doesn't qualify for CDA and could be treated as taxable income if you distribute it. So this shows why you need to monitor your ACB if you own a life insurance policy in your corporation. And then understanding how the ACB affects your CDA. By doing this, you're, as a business owner in Canada, you plan your insurance and you plan your dividend strategies more effectively. And this is something you want to talk to your accountant about basically every year. So the proper structuring ensures that the corporation maximizes the tax-free distribution while still staying compliant and in line with CRA regulations. And then for corporations that are leveraging insurance as a tool for estate planning or for shareholder buyouts or for like a loan repayment or like this underscores your need for careful tax planning. And then by integrating life insurance into the CDA effectively, your corporation can unlock this key advantage for shareholders, right? We said right at the beginning this was a key advantage, and it ensures a smoother and bigger transfer of wealth to whoever you want. So when you structure this corporate-owned life insurance, the ownership structure for this influences the CDA outcome. So historically, some corporations avoided ACB deductions by they separate the ownership and the beneficiary roles across different types of entity. However, there's been tax reforms now to ensure that the ACB is deducted regardless of the ownership structure. And again, this change highlights the need for alignment between business objectives and tax strategies. Now, trusts come up, and let's talk about trusts in the CDA. When it comes to integrating life insurance proceeds into the capital dividend account, trusts are kind of a unique challenge, right? Trusts are very common in estate planning, especially estate planning for business owners, but they don't directly flow life insurance proceeds into a corporation's CDA. This limitation can create unexpected and very expensive tax consequences if not done properly. So under Canadian tax law, life insurance proceeds must be received directly by the corporation to be credited to the CDA. So if the proceeds are paid to a trust and then to the corporation, they're not life insurance proceeds for CDA purposes for the corporation because they didn't go direct. So instead, they're treated as a distribution from the trust. So this disqualifies them from contributing to the CDA. So for businesses that are depending on the trust as part of their estate or succession plan, this distinction is very and super important. Does the insurance pay to the trust and then to the company, or does it pay straight to the company? And this is where you need to make sure your account understands how life insurance works. And I'll tell you right now that many accountants have no idea how life insurance works. Accounting for this wrong could mean losing out on the tax-free benefit that the CDA offers. And you'll be dead. So a lot harder to make any changes because you're not there. So to make sure that this is set up correctly, you need to work closely with your tax and legal professional to make sure that the estate plan is set up and that it works the way you want and that it lines up with the rules around capital dividend account. Now, let's wrap this up. Some final thoughts here. Capital dividend account allows your private corporation a great way to flow money out to shareholders tax-free, especially when paired with a strategy like life insurance planning, and especially on like your buy-sell agreements. So navigating the CDA requires attention to detail and an understanding of the limitations and an alignment with your broader business goals. So for a business owner, the CDA is not just a tax tool, it's an opportunity to maximize your shareholder value. So like I say in almost all of my videos, you need to work with somebody who's knowledgeable and experienced in the finance, that knows about this. Somebody like us. This is what we do every day. This is what we talk about at lunch. We're happy to talk about your situation. If you have a corporation right now and you want to build up money inside the corporation and you want to eventually pass that down to your kids in the most tax efficient way, then setting up a life insurance policy that creates that CDA for you is a no-brainer. Go to our website. Our website is safepacific.com. You can send us a message through there. There's a contact form that comes straight to me. Somebody on the team will get back to you within 24 hours on business days, and then we can book a meeting to learn more about your situation and to see if we can help and if we're a good fit to work together. Now, before I go, I got a little favor to ask. If you got value from today's video, please do all those things that the algorithm loves. Hit like, hit subscribe, hit comment, hit the bell, hit a heart. Do all this stuff. Leave a comment if you got a question, because we like answering those. And then also share. If you know a Canadian business owner who's making money and would like eventually to leave this to their family, this is an important video for them to watch. So that's it for today, and I will see you next time.